Hey again everyone, so now we're going to be going over the memo for Baratheon. This one shouldn't be too long because you can obviously go through the memo on your own. This is just to speak about any points that you might find a little bit tricky, or maybe just to give you a little bit more advice about each of them. Okay, so I think here we start off with part one, and part one asks you to speak about whether the expenses in relation to the customer who got sick and the subsequent donation are going to be deductible for tax purposes. So because you're playing with 11 marks, you can start giving some of the sort of fringy type general answers. So we start off by saying, hey, in order to be deductible, it must meet section 11A and not be disallowed under section 23. Then we start to look at the general things, and the first thing is to decide, is this expense actually in the production of income? So what I would suggest to you is that you need to look and see the key things. Why did the expense arise? Is this an inevitable concomitant by looking at, is it closely linked? Okay. And this is the key line right here. Now, the possibility of food causing a customer to get sick is quite clearly an inevitable concomitant of running a restaurant and can be seen to be in the production of income. I would actually expect a little bit more from this line to say that the risk of somebody leaving it out is something that will happen in a restaurant, so that's quite normal. Because you're playing with lots of marks, it might also be wise to then talk about the fact it's clearly not a fine in any type of way, even though we did something wrong. This is not anything in terms of legislation or something like that, so we're not looking at 23.0. And at the same time, as of now, I don't think this is leading to any kind of enduring benefit yet, although you may argue that it will, and we'll talk a bit about that later. Then we have to look and see, well, what happens when we raise this provision? We offered the person 50,000, we expected them to accept, but as of the date that we were looking at, they hadn't yet accepted. In this case, I think you need to tell the marker, hey, marker, we know that raising the provision is not counted as actually incurred, and therefore it's not deductible under section 11A. We also need to know that this isn't the type of provision such as bad debts or something like that, so there's no allowances on this provision either. Why we say this? Because we're playing with a lot of marks here. If this was a 2-3 mark question, we obviously wouldn't be doing that. Then we look at the actual donation itself. Now, it's important to separate the two ideas here. What actually went bad at the beginning, and then the subsequent donation. It's two different things that are happening. And in this case, we look at the donation and we say, well, it's actually incurred because we paid it. But because the PBO is not section 18A, we can't use section 18A. Then we need to look and see, well, the donation itself, could it qualify for section 11A? I think it's definitely in trade because you're doing this to protect your reputation. But by doing that, you're having a once-off expense from which you're expecting future benefits to flow, enduring benefits. I sounded like an accounting lecturer there. And this can be seen as a capital expense. The reason being, you're paying this to protect your reputation. You're doing this to fix a problem in your reputation, not in your lost sales. Therefore, it will be capital in nature and not deductible. The key thing here, this question had quite a few elements to it. What most students did wrong is that they looked at only one part of it and not the big picture. So that's what you need to be thinking about. Okay. We then moved to part B. Part B only asked you to look at the tax effects for Baratheon of the amounts received. Now remember, this was the drunk customer who was ordered to pay us 50,000, split up into 4 different things. The first 20,000 was received for the waiter. Now it went to Baratheon, but Baratheon paid it on to the waiter the next day. Clearly not for Baratheon's benefit, so it doesn't accrue to Baratheon. Okay. What you need to think about here, what would happen if I asked you for the tax effects of the waiter? Would it be gross income for the waiter, or would it not be? I'm going to leave that one to you to decide. We then have the 7,000 for lost sales, and I'm going to link to this the 20,000 for loss of reputation. Now what we need to remember here is we did this case called Burma Steamship in second year. And what the case looked at was, when somebody had something wrong with their ship and they received money, is that money for actually fixing the ship or for compensating them for sales that they can't do while the ship is broken? Very similar here. The 7,000 was for sales that we didn't get because of the problem that happened, and the 20,000 was to compensate us for the fact that people might not come in the future. The fact that our restaurant is now not as good of an asset. It's a tree that's not going to make as much fruit. So the 7,000 is to fix a hole in the profits. Therefore, that's going to be revenue because those sales would have been revenue when you got them. The 20,000 is to fix a hole in the asset. Something's wrong with your business now. You're going to be able to do less in future. Therefore, that 20,000 is capital in nature. Awesome. Then I'm going to go back to my face so you can see me. The table. Let's speak a little bit about the table. Now, the table was destroyed and the person had to pay us for that table. The question we have to ask is a table being destroyed a disposal event for CGT? And if you go back and look, you'll see it most clearly is. Pretty much everything is a disposal event for CGT. Because of that, we have to talk about recoupments and we have to talk about CGT. Now, the money that we receive for the table is going to be your proceeds, so that's 3,000. Capital in nature, so will not form part of gross income. But you do have to start to think about the CGT that's going on as well then. And if you look at the answers there, you'll see, hey, this asset, we were given the information. We know it's been fully written off because it was under 7,000. So proceeds will be the 3,000, but you're going to have a recoupment of the 2,000 Rand that's previously been deducted. And because of that, when you work it all out while doing your CGT, you'll see you end up with a capital gain of 1,000 Rand. Now, this is a discussion question, so you don't need to go into depth in the calculations, but you do need to tell the marker that you know what you would do. So you'll see the marks that are available for speaking about the 2,000 recoupment as well as the 1,000 capital gain. Okay. Now, this is a question that had quite a bit of discussion, probably more than you used to. If you look on the sides, if I go there, you will see it's 1 mark per point, but you've got the Excel in front of you anyway. You need to get used to possibly having a question with this much discussion at the start. Good. Then part C. Part C starts off, and we start off with the taxable income that we are given, being the 400,000. The restaurant sales go in, no questions there. Again, nothing special about purchases, opening stock, or closing stock. The stuff you do need to speak about in a bit more depth. No write-up, reason being, you can't ever write stock up. And then we have the 22/8 recoupment that we spoke about earlier. Those beverages were not being used in normal sale, therefore it goes in at market value, and it comes out at market value just a little bit afterwards because we're still using it for trade. The fun part, in my mind, of this TUT is more about the machine. Now with the machine, there's some key stuff to remember. I'd probably suggest starting here. We bought the new machine. We paid on the 1st of August $24,000. We didn't pay, we incurred $24,000 on that date. And the machine will be recognized at spot rate. Spot rate being the 14.86, written off over 5 years. And if you do it, you work out and you see, hey, when did we buy this machine? And when I scroll up, you will see the machine was bought and brought into use on 1 August 2020. So what we are going to do, you get to see me again, because we need to count and say, well, we brought it into use on 1 August. So we've got August, September, October, November, December. That's 5 months. There we go, 5 months. So that's why we have 5/12. The old machine we bought in 2014. If you work 5 years from that, you'll see it was fully written off last year. So there are no allowances in the current year. Okay. Then we get to the Forex. We've got 2 issues, the Forex on the debt and the Forex on the FEC. The debt is going to be for the full amount because it's what you owe, and it's going to be the difference between the day that you incurred it and the day that you paid it. You incurred it on the 1st of August, so we use the 14.86. We paid it on the 1st of October, so we use the 15.02. And the question you need to think about is we're paying in this scenario. So instead of paying 14, we're now paying 15. So that is going to be a loss, okay? Which means the amount gets deducted. Then we have to look at the FEC. Key things to remember. It was only for 10,000, not the full 24,000. We locked it in at a rate of 14.76, and it ended up being a rate of 15.02. So what that now means is that we only have to pay 14.76, whereby if we had left it and done nothing, we would have been paying 15.02. So we're able to do it at a cheaper rate, therefore that is going to be a gain, which is why you have a positive amount going in there. Other things that you need to think about: the old machine, when we sold it, is going to have a recoupment. It's limited to cost, which is the 50,000, not the 60. There's no tax value because it's fully written off. So you're going to have an 8.4a recoupment going in. That recoupment can't be deferred because you didn't use the proceeds to fund the new asset. So we don't even have to look at any of the other requirements. Okay. I'm going to deal with this part at the end here, and then we'll come back to the rest. At the same time, you had the computer system. You worked out the recoupment, so you also have to work out the CGT. The key things here: proceeds in this case 60, less any amounts included or which are going to be included in taxable income. In this case, that is the recoupment. You have the base cost being what you paid for the asset, less all of the previous allowances. And of course, it's fully written off, that'll be 0. That gives you a capital gain of 10. Linked to this, your gain from the table above in the discussion questions of 1,000 gives you your net capital gains included at 80%. Your copyrights, what you need to remember: acquiring the copyright, you can get the 5% allowance on what you spent on the copyright. What you spent to register it, not allowed as a deduction. That's one of the exclusions. The design, remember, is at 10%, not 5%, but you can also claim the registration costs all up front. The one question that I need you to think about here, have a look to see if in the relevant sections, GB and GC, you are required to apportion these or not. I'm going to leave this as a bit of self-study, and I want you just to have a look and to see, hey, do these sections tell us to apportion, or do they tell us not to? Sound good? Have a look at that. Then, the last little bit of this question that we need to focus on is the lease. Now, we spoke earlier and said that the lease, we don't own the asset, so we are quite clearly not going to be allowed to get allowances. So we're going to be looking at deducting that 5,000 Rand per month. Now, what we need to think about is, well, when did we acquire the use of this machine? Over here, we acquired it on the 1st of April. Okay, so when we look at this, we do 9 months. Reason being, we count and we go, we had it for April, May, June, July, August, September, October, November, December. There's the 9 months. So at a minimum, I'd want to see 5,000 times by 9 as a deduction. However, with VAT, what we do in this scenario is we actually take the full value of VAT on the asset's value when we buy it. That will be the total VAT. What we then do, we split that VAT over the number of months, and we take it off of each payment. If you've done tax 327 before, I would expect that you could do this. If it's your first time, then this is something we're going to cover when we get back from term 1. And that pretty much covers everything that you need for Baratheon. You're going to see me again. This is my first time ever recording one of these videos. I think the sound is working this time. So let me know how the video goes. Let me know if you're able to see everything, how it sounds. I'm going to try upload these on a Canva, as well as to see if any other methods might be easier for each of you. I'm also going to play around with the sizes and stuff like that. So yeah, just give me any feedback. The plan for the rest is I'm going to record a few more of these on the other tuts. I'm also going to be able to try and finish off lectures. And what we need to think about is we're going to have this week holiday coming up where you can maybe do a bit of relaxing, a bit of revision. But then the time after that has become vacation now, I don't think we can keep as vacation. So in that time, we're going to post a plan. I'm going to try and have that everything ready for you by the Monday that you would have come back from VAC. And that will be what you do in the sort of week and a half, 2 weeks that we have afterwards. Included in that will be some lecture videos. I might push forward the lectures for donations tax and estate duty and do them online, but we'll see what happens when we have more information going forward. Otherwise, I hope this has gone well. Let me know how things are. Cheers.